Good morning. Happy spring and welcome to the Maine Community Foundation's 2022 Investment Program Review. I am Leanna Kingsbury, our Director of Nonprofit Agency Funds, and we want to thank the various donors and nonprofit organizations that are joining us here today and appreciate you taking the time to learn a little bit more about how our investment program is run and meet some of the folks doing that. So to get things started, we will have some presenters today. I will cover some of the logistics as well as a bit on the Community Foundation itself. Then we'll turn things over to Sterling Spearin, our interim CEO and president. Sterling has been with us for about a year and will share some highlights of what's coming up in 2022. And then the bulk of the webinar will really be handled by Brendan Ray, who is our Vice President of Investments. So Brendan will be joining us later on in the presentation. Some of the logistics today, we have disabled the chat feature, but encourage everybody to use the Q&A, which I think for most of you will be located down at the bottom of your screen. I will be keeping an eye on those questions, so feel free to submit anytime, and I will make sure that they get addressed before the end of the program. For those of you that prefer to email or maybe listening to this webinar at a later date, please feel free to reach out to either Brendan or me at any time, and our emails are included on this slide. I should also note that participants will be emailed a copy of this presentation after the program today, and we'll also have this available on the Community Foundation's website. So just to get things started, as a brief reminder, I think for most of you, but in our 39th year at the Maine Community Foundation, our mission has remained essentially the same. We are here to work with donors and other partners to improve the quality of life for all Maine people. And we do that through really a strong understanding of local needs, a big commitment to community, and a prudent and consistent oversight of the assets that have been entrusted to us. So, very simply put, we know Maine. And with that, I am going to stop sharing the presentation for a minute and turn things over to Sterling, who will give us a bit of his thoughts about what's coming up in the next year. Sterling?
Thank you, Leanna, and welcome everybody. It's great to be with you all today. I'm coming to the end of a one-year interim service at Maine Community Foundation, and it has been a real honor and joy to work with the board and the staff, some of our nonprofit partners and our donors. And I just want to thank everybody for this opportunity. Despite the many challenges that the COVID pandemic has brought all of us, it's been a very productive year at the Maine Community Foundation. Of course, I think our biggest news is the search committee's work under the fabulous leadership of longtime board member Karen Stanley has found us a new CEO in Deborah Elwood, who happens to be a good friend of mine. And we're delighted that Deborah is going to come back to Maine after being at Bowdoin many years ago, and will be joining us as our new CEO late next month. Also excited that we've added a lot of new staff. You're going to hear from our new Vice President of Investments, Brendan Ray, another incredible find for us, a Mainer already, having moved to Blue Hill just a few years ago. And the investment committee and our staff team worked hard to find Brendan. We're very excited to have him. We've also added to our incredible group of veteran staff. We've added new staff in program, in philanthropy, in donor services, in finance, in grants management and scholarships, and on our communications team. So we're very excited to be positioned for the year ahead. Finally, I want to thank the Strategic Planning Committee led by our board chair, Greg Collins. The Strategic Planning Committee, composed of board members and the management team, has met almost every month for at least 3 hours, mostly through Zoom, a few in-person ones most recently, yesterday, at our Ellsworth office. And we're very excited as Deborah Elwood arrives that our strategic plan, which takes a very thorough look at our organization, a refresh of our mission and vision, and I think the Maine Community Foundation is going to be incredibly well positioned to take on the challenges of the future and to be partners with all the people of the great state of Maine. We're also going to be saying goodbye to two of our board members, Karen Stanley and Matt Polstein. And next month at our annual meeting, the board will bring on two new board members. So very excited with that. And with that, I want to turn it back to Leanna and look forward to hearing Brendan's presentation on a review of our investments over the last year. Thanks.
Thank you, Sterling. And I should say we really appreciated having you with us for the past year. We look forward to meeting Deborah, but we were lucky to have you come and steward the Community Foundation through this past year. It's been a busy one, as you can see. And I think Maine's made quite an impression on Sterling, so I think we'll see him back here soon. So let me again share the presentation with everybody. And what you should be seeing now is a breakdown of the various types of funds that we manage. We do strive to partner with all of our donors and nonprofits and helping them with their philanthropic goals. And we do that by managing a variety of different types of funds. As you can see from this pie chart, the largest slice goes to our donor advised funds, with about 38% of our assets held in funds that were established by donors or groups of donors who will advise us on where they would like those grants to go. The second bucket is our agency fund partners, and this is the group that I work most closely with. Our nonprofit agency fund program is specifically for other nonprofits that have assets of their own, but they'd like to invest them through the Community Foundation. So we certainly appreciate that partnership and are happy to offer some of our investment expertise to other organizations in the nonprofit sector. Then we have designated funds, which are permanent endowments. For the most part, they're permanent endowments, and they're established by donors that name a nonprofit organization as the beneficiary of those funds. Our field of interest funds are our competitive grant-making funds, and so this is a big piece of what we're doing, and we're very active year-round on making sure our grant programs are running smoothly and really benefiting other nonprofits around the state. We've got, I don't know, about 30 or so programs that are doing a variety of different types of things, and so any of our competitive grant programs would fall under that field of interest classification. And then our scholarship funds, we still have a very robust scholarship program with about 400 funds that are providing assistance to folks around Maine that are pursuing their educational goals. So a quick overview, excuse me, there we go, not too far there, of 2021. It was a busy year for us, as Sterling highlighted some of the changes administratively that went on. We had 2,100 funds under management. That's in total of those various fund types that we just looked at. And altogether, they made up our total assets of just over $775 million, which is pretty impressive. After 39 years, we started with a $10 donation and have managed to get those assets up to an impressive amount. So thank you for that. In 2021, we awarded a total of about $58 million in grants and scholarship. And that included $4.3 million from our COVID Emergency Relief Fund, which we really appreciate donors that stepped up, remarkably stepped up and supported that fund. And we were able to provide a lot of quick and ongoing relief for organizations that were working on COVID-related issues. Our competitive grant programs, that's those fields of interest funds, awarded $4.2 million to nonprofits across Maine. And in scholarships, we were able to get about $4 million out to individuals to help them pursue their educational needs. And then donors really stepped up and came together, and in 2021 granted out about $29 million, which is an impressive number. But part of that was also 1.7 that was made through our Giving Together program. And this is a really neat opportunity and a great way for donors to learn a little bit about what's going on in our competitive grant making cycle. Giving Together lets donors review proposals and award those out of their donor advised funds. So we were very pleased and appreciative of donors that were able to take part in that and look forward to doing that in the future. So I will now turn things over to Brendan. As mentioned before, Brendan is our Vice President of Investments. He's been with the Community Foundation for 2 months now, but brought a wealth of knowledge and understanding of investment strategy, has been a great member or great new member to the team. I'll let Brendan share a bit about himself, but as a brief overview, he's got a really interesting background that includes not only a career in investment consulting, but he's a former professor of classics, a U.S. Coast Guard veteran, a Alaskan fishing guide, and as I learned more recently, a bit of a craft beer connoisseur. So, Brendan.
Thank you very much, Liana. And I'll talk for a second and then I'll share my screen. And I just want to reiterate the thank yous from Liana and from Sterling. Just really grateful that you're here. Thank you for your time and spending a little bit of it with us today. I'll share my screen now, and then let me get this up here, and then pull this over here. Give me 1 second here. I hope everyone can see that all right. So I thought I would just, Leanna already mentioned a few things. I've been here all of 2 months, and I know what some of you are thinking. This guy showed up 2 months ago, and holy cow, has the investment world really gone south on us. I promise you, it probably is just a coincidence. So my very quick background, I'm from Seattle originally, not from Maine, but I got here as fast as I could about 4 years ago. My wife took a position at the University of Maine as the Stephen King Chair in Literature. So thrilled to be here. And you can see my educational background, a few of the things that I've done. In 2007, I joined Cambridge Associates, and I was there as an investment consultant, then spent a bunch of time in the hedge fund world. And then more recently, when I was here in Blue Hill, founded my own consulting and private equity firm called Harbor House Partners. And then Maine Community Foundation and we found each other, and so far it's just it's wonderful and a real privilege to be doing this work. So thank you. I'll jump right into it. This slide shows the growth of assets at MaineCF from 2000 to 2021, so December of 2021. And you can see that the portfolio, the investment returns, as it has in many places since 2009, has just been wonderful performance growing the assets, which of course the good news is then more assets to give away. So just thrilled with both the stewardship and the growth of assets since then. At a high level, I thought I would just talk very quickly about return and risk. These are the two key axes, if you will, in investing. Our investment objective is to achieve the highest risk-adjusted returns that we can over a longer periods of time. So we're not too concerned about, well, we're concerned about, but we don't make decisions based on what happened last month or last quarter or even last year, have a much longer perspective. Our mix of investments aims to return 5% plus net of inflation. And as we all have been reading about and hearing about, inflation is back. It's a hot topic. And so we're happy to talk about that a little bit later, but that's our bogey. That's what we're aiming for. And alongside returns, it's always nice to talk about things doing well and returns. We also have to talk about risk, and there's two kinds of risk. The first kind of risk is what we're experiencing now, short-term fluctuations in the value of investments. That's volatility. That's very normal. It sometimes doesn't feel good when things are going the wrong direction, but it's normal. And of course, we haven't experienced a lot in the last 15 years of downward volatility to the downside. But this is normal. we try to build a portfolio that is going to withstand those periods of volatility and then continue to grow. The longer term risk, this is bad risk. This is the permanent loss of capital. Warren Buffett has a oft quoted rule. The rule number one in investing is never lose money. Rule number two is never forget rule number one. So the permanent destruction of capital, whether you're buying high and selling low, you start with $20 and you sell something for 10, and you're out, you're out $10. Or fraud can be another way that you can permanently lose your money. That's the kind of risk, very bad risk. And what do we do to counteract that, if you will, or to avoid that? Well, due diligence is crucial. We use a investment consulting firm called Monticello Associates, and Monticello Associates is our partner in due diligencing the various investment managers that we work with. Diversification is another important part of both the near-term volatility and the longer-term risk of permanent loss of capital. And this is, you don't have all your eggs in one basket, basically. And I'll show you a slide that will illustrate this a little bit better. So diversification and due diligence are the two major ways that we manage, if you will, the short-term and longer-term risk. And we will remain a long-term, vigilant, diversified investor, safeguarding growing the assets you have entrusted to us. I've got this on a postcard taped on my desk. This is who and what we are in the investment program: long-term, vigilant, diversified. It's about safeguarding and growing the assets that you've entrusted to us. And as Leanna said, I was a classics professor, and so I get particularly interested in etymology. So bear with me, this is a little bit of a footnote to this. So when I used that word vigilant, when I was making these slides, it reminded me that it comes from a Latin verb, which means to keep awake. Hopefully we're doing better than just staying awake. As an adjective, it means watchful and anxious and careful. So I think that those are three buzzwords that we live by in the investment program: watchful, anxious, and careful. And then I dug a little further, and here's something that's kind of interesting. The Indo-European root from which this Latin verb comes means to be strong and to be lively. I'd like to be both of those things, strong and lively, as the portfolio would like to be. But here's the other neat thing. That root, which is weg, it forms all or part of a number of other familiar words that we have in English, and I'll pick out a couple here. One of them is vegetable. So eat your vegetables. They will keep you strong and lively, and hopefully be good for your portfolio as well. And the other one, two other ones these ones don't strike me as particularly obvious. One of them is wicked. So if you're wicked smart, then your smartness is strong and lively. And the last one is witch, and I'm not even really sure where to go with that. But so there, I hope when I do these presentations, we'll try to have an annual etymology tidbit that I'll throw in there. So we are vigilant, we are watchful, anxious, and careful about the investments that you've entrusted to us. I mentioned diversification. I hope you can see this slide okay. It is in the consulting world, this is called the quilt slide. And I hope it's big enough for you to be able to see. Even if it's not, when you get the presentation later, you can look at it. I'll describe it very quickly to you. Each one of these colored boxes represents a different asset class. So for example, at the top of the screen of the picture, you'll see the bright yellow boxes. Those represent what's called the Russell 1000 growth. It's an index. It's a collection of growth stocks, U.S. growth stocks like Microsoft, Netflix, Amazon, Apple. We all know about these stocks. And you can see those yellow boxes at the top. That means these have been, that group, that basket, if you will, of assets has been the top performing asset for that year. So, and then over on the right, there's a separate sort of column of boxes, and that shows the 1, 5, 10, 15, and 20 year best performers at the top. You'll see those bright yellow boxes, 5, 10, and 15 years. The best performing asset in the world has been U.S. large cap growth stocks, Amazon, Apple, et cetera. I'm sure many of us, if not all of us, are very familiar with that. But look over at that, it's sort of that olive looking box on the far right under the 20 years. That's the MSCI Emerging Markets Index. So it turns out over 20 years, the best performing asset class have been emerging markets equities, excuse me. And at the very bottom, look at the bottom, the black box. This is a commodity index, oil, wheat, coffee, etc. For many years in a row, commodities just got smoked. Boy, you just lost money hand over fist in the commodity markets. That's going to change in 2022. That's just about the only thing that is working in 2022 is commodities. And so the point of this chart, all these different colors are a different asset class, a different basket of assets. And what it shows you is that in any given year, you don't know what assets are going to do better than other assets. And so the point of diversification is to make sure that we have our hand in all of the different buckets so that we're taking advantage of all of the possibilities that we can in order to, one, safeguard, and two, grow the portfolio. So this is the quilt chart. And I hope you have a chance to take a look at it on your own, and I'm more than happy to answer questions about it. So let's talk about performance. This slide shows the investment performance of the primary pool annualized, and it's as of December 31st of last year. The Maine Community Foundation portfolio is in blue, sort of a navy blue, and the orange color, the pumpkin color, that is our benchmark. So that's our internal benchmark that we measure ourselves against. The yellowish bar is a benchmark of 60% of the ACWI index. That's an all-country world index of stocks, and then 40% of a bond index. So it shows how that has performed. And the little light blue bar is CPI, a measure of inflation. You'll notice in 2021 that little blue bar got a lot bigger, as we all know. So listen, the portfolio has really performed well, for a long time. In 2021, it was up almost 16%. That's net of management, net of the manager's fees that we hire. In the 3-year mark, it's up roughly 16.5%, and you can see the numbers from there. So the foundation, take a victory lap. It's great, because the next slide is unfortunately not going to be nearly as attractive. As we all know, things have changed a little bit recently. So this slide shows our investment performance, still taking the longer term view. It's annualized, but it's as of March 31st, 2022. So at the end of last quarter. And I'm happy to tell you a little bit about our April numbers too, which they're not quite final, but they're starting to come in a little bit, so we can see a little bit about how things are going. So as we all know, Q1 2022 is not a very happy time. Again, don't take my joining Maine Community Foundation as indicative of anything. Our portfolio was down 5%. That number has been tightened up a little bit more. It's almost exactly 5% as opposed to 5.2. We underperformed our policy benchmark by about 40 basis points. And then you can see from there. Notice the only line that went up is inflation. Again, something that I'm sure we're all familiar with. And you can see then the annualized performance on the 3, 5, 7, and 10-year basis. And then since inception in December of 1993, you can see that the portfolio has returned 8.3% net. So that's where we stand as of Q1. I know that this call, by the way, in the past normally has only focused on the previous year's results. Because it was so late this year, I figured that we might as well talk about Q1. There's no reason not to. It's not a very pretty quarter, but it is as it is. This slide shows the investment performance against a benchmark, a collection of other endowment and foundations. In that thing in Invametrics there, with an odd name, that's just a company name that provides this index, this benchmark of endowments and foundations. And you can see where we stand in the average. So very happy to report that we're outperforming the average endowment and foundation in the United States. And hey, good for us. That's terrific. So we're outperforming many of our peers. This shows us, it's a different cut, but a similar idea. This chart shows the investment performance of the community foundation compared to other community foundations, so our real peer group. These are other community foundations like us who have assets from 100 million and up. And I went back to 100 million because it wasn't that long ago that that's how big the Maine Community Foundation was. So I started there. And again, you can see that against our peer group, the average peer group as collected by the Council on Foundations, again, we are outperforming our peers very nicely. I want to switch gears for a second, and so that's performance. Again, happy to talk about it, take questions about it, et cetera, et cetera. I want to take a couple of slides and talk about responsible investing. This has got a lot of different monikers, a lot of different tags to it. ESG is the category that is probably most prominent right now. And there are different sort of flavors, if you will, whether you call it sustainable investing, socially responsible investing, and there's nuances between these things. I'm not trying to lump them all together, but they are all of a similar genre. And investors, perhaps many, if not all of you, are increasingly more focused on the relationship, the alignment of values and investments. ESG factors, environmental, social, and governance factors are becoming more mainstream. I think a number of years ago, it was seen as not so mainstream, but there is enormous pressure and enormous adoption across the investment industry about these different sorts of factors. Diversity, equity, and inclusion, or DEI factors, are also becoming more widespread in the investment industry. Not as fast, and there's a lot more work to be done, but more and more managers are beginning to track this data and take it very seriously. In 2021, so this was last fall, the Community Foundation, we undertook a review of all of our investment managers to understand exactly what level of ESG awareness we had in the portfolio. And I'll tell you the results, some of the results of that in just a second. DEI, as I mentioned, it's lagging a little bit, but more and more managers, and often in very sophisticated ways, are beginning to report their own firm information about diversity, equity, and inclusion, especially, and it's continuing to gain speed. And this is a trend that will continue. We will see more of this in the industry, and that's to the good. So a couple of things about our portfolio, about the MaineCF portfolio. When we did that audit last fall, so and we're due for another one, and I'm confident this number will increase. 75% of our investment managers have an ESG policy. They have adopted a policy. 32% of these investment managers have a dedicated ESG analyst. So they are putting at least some of their money where their mouth is, and hiring professional staff to assist the, let's call it, more conventional analysis of investments with interweaving, incorporating ESG factors into the way they think about the investment world. So another factoid. So we've got more work to do there. So 75% of the portfolio, hey, terrific. But we have more work to do there, and really looking forward to seeing how that number goes up on our next audit of our investment managers. Our largest private equity position in the portfolio, so private equity, I guess what the name implies, as opposed to stock market, which is all publicly traded equities. Our largest private equity position is with a firm founded by and is currently run by a woman. And then going forward, again, a few little factoids. Going forward, we are going to be much more vigorous, much more vigilant. We're going to be much more vigorous about evaluating different investment opportunities for impact investments, and also taking into account DEI factors. We want to be involved with investment managers that with higher scores, if you will, in DEI, whether it's whether it's women, whether it's underrepresented minorities. We want to be including these managers in the searches that we're doing going forward. And we will be evaluating opportunities for impact investments. So that's what I wanted to, and again, happy to take questions about these things and try to fill in any blanks or if I'm unclear. So thoughts for 2022. Despite the painful recent downward move, U.S. equities are still trending above historical average valuations in many respects. The EFI and EM, that's sort of the rest of the world, if you will, compared to the United States. Some of those markets are actually trading below their average valuations. Rising interest rates, as many of you, if not all of you may know, put a lot of downward pressure on bonds. Here's a good decision that in the portfolio, we have a pretty small allocation to fixed income. So the downward pain in bonds did not impact us as much. I mean, Q1, the big challenge with Q1 is that there was nowhere to hide. Equities were down, fixed income was down. The only thing that went up in Q1 was oil. So usually you don't have everything all going down at the same time, but that's exactly what happened in Q1. Inflation, very hot topic. Now, yesterday, you may realize that the FOMC raised rates 50 basis points. The market rallied very strongly, you may have seen. And I think on the expectation that the Fed is going to be able to manage more of a soft landing than a hard landing. Inflation, the previous year's inflation is running very hot at around 8.5%. Inflation from low inflation as we've had for the last at least 10 years, keep going back and looking at the data, up to around 5%. Equities actually historically have been okay in a rising rate environment, and with inflation up to around 5%. Over 5%, that's not a good recipe for equities. So it'll be very interesting to see how the Fed is able to manage inflation going forward. And then the question to which I don't have an answer is will there be a recession? And that's obviously a hot topic. And gosh, if someone knows the answer, please let me know. Please let me know what it is. The important thing, or all of these things are important, but let me single out again, at the risk of repeating myself, we are and we will remain a long-term, vigilant, and diversified investor, regardless of a recession or not a recession, regardless of what happens with inflation or interest rates. The job is to continue to safeguard and grow the assets in a diversified portfolio. So we're not built to be responding on a weekly or monthly basis to this or that. It's a well-diversified portfolio. No portfolio is bulletproof. It's rock solid. Some of the best investment managers on the planet are managing money on our behalf. And we're constantly looking both to upgrade, to find managers that we think can do even better, and to continue to diversify the portfolio in ways to, again, continue to provide downside protection as well as to grow the portfolio. Thank you very much. I'm happy to answer any questions, and as an old professor, look, I could talk forever. But I wanted deliberately to keep this a little bit on the shorter side. More than happy to answer questions. I do have 2 more slides here. I put as an appendix. When you get the presentation, it'll be here. This is the Maine Community Foundation Investment Committee. You'll see all the people here, an illustrious, very accomplished and intelligent group of people that work relentlessly on the portfolio, thinking about and meeting on the portfolio. And there's a blurb about our investment consultant if you want to learn a little bit more about what's going on with Monticello. So with that, I'll stop. And I see that Leanna has come back. And
we do have a few questions, Brendan.
Great.
So the first one has to do with inflation, and you did mention that a bit, that obviously it's on the rise, but specifically asking about the long-term outlook for inflation. How might that differ from the past 10 years, excluding the most recent 6 months? And if there is going to be a different approach, have changes been made to the portfolio due to that change?
Yeah, look, I mean, I do think that the era of sub 2% inflation, which is what we've experienced for so long, I don't see that in the near term or even in the medium term kind of coming back to that. That is the target for the Fed, by the way, 2%. So, we'll see how well they're able to manage down to that. I would really be happy to see we get to the end of the year if we're somewhere in the 3s or the 4s, something along those lines, and see how that goes going forward. We have not made any changes to the portfolio right now. I think we anticipated inflation, this spike in inflation, anticipated it pretty nicely with a reduced allocation to fixed income. But for example, we have not added a lot of commodity, frankly, but we haven't added commodities exposure, for example, which is probably the most effective hedge against those spikes in inflation is to own commodities. As I said in Q1, oil was the thing to own. That's the only thing that went up. So no, we have not made any changes. It's a topic for our next investment committee meeting, which is in about 2 weeks, and I expect that we'll be talking about it. But I can't predict any or promise any major changes to the portfolio where we are now.
Great, thank you. Couple other questions. One was, you had mentioned a private equity firm that was founded and run by women, and folks were interested in which firm that was. Accolade
Capital, ACCOLADE, but down in the Washington, D.C. area, Accolade.
Great. And then as far as ESG, you described the various ways that, that can be defined, but does that relate to how the firm runs their company or the investments that they make?
So, good. So ESG factors. Okay, so environmental, social, governance. And if I'm not answering the question, ask it again, and I'll try not to be so obtuse. So make sure I get it. So companies are self-reporting their environmental, social, and governance qualities, criteria, characteristics. How much carbon do they emit? What is their shareholder policy? That's a governance thing. How do they treat their supply chain? That can be a social factor. So that's companies out there in the world, Apple and whomever else. That's companies. Investment firms themselves then are taking that information and trying to understand what are the risks to an individual company. If they happen to own a handful of Superfund cleanup sites, well, that's going to be a big risk, right? I mean, so different kinds of risks from that point of view. It's a way to try to sift or to evaluate companies based on. It's kind of, I guess, maybe the better way to say it is it's sort of a quality measure of companies. So investment firms are using those factors to try to understand in even more detail the character of the investments that they are making. So it's sort of it's the investment firms and then it's the companies themselves. I hope that gets at the question.
I think it does. And wait a minute, we've got one more question coming in here. Let's take a look at that. Okay, so this question is, the community foundation funds are about what beta is compared to S&P 500. So for instance, if the S&P is up 1% in a day, what percentage do you expect the portfolio to be up?
Yeah, that's a good question. Our beta is right around 0.7. So we definitely we definitely move with the markets, although not completely.
All right. So I believe that takes care of the questions. But of course, as I mentioned earlier, if you think of something later, please feel free to reach out to Brendan directly. His contact information is in the slide deck that you'll receive later on. And I would just like to add that we're always looking for feedback on this presentation. It's something that we hope to offer on an annual basis. So if there's other elements that you would like addressed, please let us know, and we will do our best to accommodate that going forward. Again, thank you for joining us today. We certainly appreciate the partnership with our donors and nonprofits, and hope to have a fruitful year coming up. Brendan or Sterling, anything, final thoughts?
I just want to say thank you. I'm thrilled to be here, and please don't hesitate to contact me by email or phone or however, smoke signals, however you want to get a hold of me. Come by our headquarters here in Ellsworth. I'm here every day. I'd be delighted to meet you and answer any questions that you have. So thank you very much.
And I'm going to be continuing to watch the performance as a good donor advisor at the Maine Community Foundation. I'll continue to have a stake in the success of the foundation.
All right, awesome. Thank you.
Thank you all. Bye-bye.